Policymakers responded with aggressive monetary easing and unprecedented quantitative easing, plus fiscal interventions in some countries. Those actions helped stabilize markets and support a recovery in asset prices. However, the recovery in the real economy was uneven, and debt levels remained elevated relative to incomes. The post-crisis period shows the interaction of short-term policy fixes and long-term. Debt dynamics policy can stabilize immediate damage, but may leave long-term imbalances unresolved. Another instructive period is the post-World War era in many advanced economies. In the immediate post-war decades, governments and societies made significant investments in productive capacity, infrastructure, education, industrialization, which drove strong productivity growth. Those decades sustained robust growth without runaway debt accumulation. By contrast, in later decades, productivity growth slowed in many countries while financialization and debt accumulation increased. The difference in outcomes highlights the centrality of productivity. When the economy's productive base grows, it can absorb more debt without the same risk of a painful deleveraging. It's also important to understand that not all debt is the same. Productive debt borrowing that funds investments that raise future incomes or productivity, such as business expansion, education, or infrastructure, can pay for itself over time. Unproductive debt, borrowing for consumption, or speculative investments that do not generate real income growth, increases vulnerability. Distinguishing the composition of debt in an economy matters when assessing long-term risk. An economy where debt finances productive investment is in a far better position than one where debt mainly finances speculative asset bubbles or consumption, without improving future output. Communication, expectations, and confidence play outsized roles in the dynamics of cycles. Economics is not just about physics-like forces. Human psychology and expectations shape outcomes. If borrowers and lenders believe a crash is imminent, their behavior can precipitate one. If they believe policy will backstop markets, risk-taking can increase. This reflexivity means that central bank credibility and transparent, consistent policy frameworks matter. Clear communication that anchors expectations can reduce market panic and smooth cycles. From a policy perspective, Dalio's framework suggests prudence in the accumulation of debt during expansions and the importance of building buffers. When credit is expanding rapidly and asset prices are rising, policymakers should consider macroprudential measures, higher capital requirements for banks, limits on leverage, countercyclical buffers to reduce the buildup of systemic risk. Relying exclusively on monetary policy to manage cycles encourages debt accumulation, because easy money is a blunt tool that affects all sectors. Stronger fiscal discipline and targeted regulations during booms can make deleveraging less painful later. There are also geopolitical and distributional consequences of how cycles and policy unfold. Prolonged periods of low rates and asset price recovery can disproportionately benefit those who own assets, increasing inequality. Deleveraging through austerity can disproportionately hurt lower-income households. Debt restructuring and inflation can reshape wealth distribution in ways that affect political stability. Understanding the linkage between debt cycles and social outcomes helps explain why economic crises often lead to political realignment and policy shifts for individuals seeking to apply this framework to their own finances. Start with an honest assessment of personal leverage and liquidity. If you have high debt relative to your income and your cash buffers are low, you are vulnerable when credit tightens. Prioritize building an emergency fund, reducing high-cost debt, and investing in skills or assets that enhance your earning potential. Consider the macro environment. When credit is cheap and asset prices are rising, be cautious about over-leveraging. When you believe a deleveraging is likely, increase liquidity and reduce exposure to highly leveraged speculative plays. For entrepreneurs and business owners, focus on sustainable business models that do not rely on perpetual cheap credit to survive. Manage balance sheets prudently, hedge financing needs, and invest in productivity-enhancing technologies that lower unit costs and raise competitive advantage. For investors, maintain diversified portfolios that include defensive positions and inflation hedges, and rebalance regularly to avoid concentration in overvalued sectors. Dalio also stresses the value of historical study. Cycles repeat in form, even if the details differ. Reading past deleveragings, monetary regimes, and fiscal responses reveals patterns and informs better judgment. No model predicts perfectly, but a framework based on transactions. Credit, productivity, and policy responses sharpens probabilistic thinking and reduces blind spots. Finally, remember that this framework is diagnostic, not deterministic. It helps you ask better questions. Where are credit and debt relative to incomes and productivity? How are policymakers likely to respond in a downturn? Where are asset prices relative to fundamentals? Combining this macro lens with micro-level analysis company fundamental, balance sheet strength, cash flow prospects yield stronger decisions. To summarize the essentials in plain terms, the economy is transactions made possible and amplified by credit. Productivity determines sustainable long-term growth. Short-term debt cycles create regular booms and busts. Long-term debt cycles require deleveraging when leverage becomes excessive. And policy choices shape the severity and distributional outcomes of these cycles. Understanding these interacting forces gives you a clearer map for navigating markets, making policy or managing personal finances.